Hey, what's going on, guys? Some of you had asked me earlier about Robinhood and margin and what it means to buy on margin. Well, buying on margin basically means that you're borrowing money to make your purchase, that all the money isn't your money. And I'm not against the idea of buying on margin. I think that margin can work for you. I think leverage can really benefit you, but leverage is power. It's a type of financial power. And so it's just like a powerful car. The more powerful the car, the more careful of a driver you have to be. So just be really careful with your margin. And so a couple of things I wanted to mention about Robinhood in terms of how Robinhood margin works. The amount of margin that they allow you to have comes down to how much you put into your account. So the more you put in, the more they put in. And also, the type of margin that you have and how much you can use comes down to the types of stocks that you own. They create what they call a maintenance margin, which is the amount of money that you have to have in your account that basically serves as collateral to make sure that they don't lose their money. So the reason they're so quick to loan you money is for the same reason any bank would be willing to loan you money, is because you have collateral. You have assets right there that they can grab in case you don't pay them back. So the default rate isn't going to be very high for a company like Robinhood. So what happens with margin is, if you make an investment, let's say that you have $1,000 and that's yours, and you borrow $1,000. Let's say they give you $1,000 of margin, then that means you could buy $2,000 worth of stock. So let's say that $2,000 worth of stock turns into $5,000. Well, $5,000 is yours minus the amount that you owe. So $5,000 minus $1,000 is $4,000. So that's where leverage gave you extra economic power. Now, let's say that the price drops. Let's say that you buy $2,000 worth of stock and the value of that stock drops down to, say, $500. Well, all that money is going to go to them. Then none of that is yours at that point, because all the losses belong to you. All the gains belong to you and all the losses belong to you. That's what makes leverage so impactful on a good and bad note. So you don't want to go overdo it with leverage, but it can be a valuable tool. Also, the amount of margin that they allow you to have comes down to the types of stocks you own. Some stocks that, or investments that tend to limit the margin are volatile stocks. Stocks have a lot of up and down, a lot of crazy volatility. What they might call penny stocks, or very low price stocks, stocks that cost under $4 a share. Stocks that are young stocks, especially young stocks with small stock prices, just tend to be all over the place. They're little economic babies, and you never know what a baby's going to do, right? And so recent IPOs, they don't let you borrow a lot of money to do recent IPOs. And also some ETFs, exchange traded funds, have a lot of leverage attached to them as well. So they tend to limit you for that. Now, if the market crashes and you have leverage, what might happen is you might get what they call a margin call. A margin call basically says that the amount that your equity is worth, because of the price to come, remember, all the losses are yours. So as the value of your assets drops, they're going to basically say, okay, we need you to have a certain amount of skin in the game to protect our investment. So when the market starts to crash, you start getting a lot of what they call margin calls, where basically Robinhood gives you 3 days to make things right. So they say, look, we need you to have a certain amount of money in your account. So either make a deposit or you can go ahead and sell some stock. But either way, you got to do something. So part of the reason that market crashes just tend to be really terrible is because as the market's declining and all the investors are investing with margin, they start getting margin calls. And if they don't have the cash flow to satisfy the margin call, then they end up selling stock. Well, guess what? When more and more people are selling something, the price, does it go up or does it go down? It goes down, right? So ultimately, margin calls can be stressful. Just know you get 3 days to resolve it. You can resolve it with either cash or selling stock. And I think margin overall is a good thing. I would just say be very, very careful with it, though, because it can get you in trouble if you don't do it right. So anyway, guys, I'm out of here. If you want to see more stuff like this, more of the conversation we've had about investing, feel free to go and log in at theblackstockmarketprogram.com. THE, that's theblackstockmarketprogram.com. I'll see you guys soon. Have a good day. Bye-bye.